so I almost didn't make it in today. I got completely stuck rereading my own trading journal from like 2 years ago. And wow, past me was a disaster. Welcome to episode 37 of the Join Prop Podcast. I'm Ken, and that's Jessica.
Wait, you actually keep a physical journal, like pen and paper? I'm just picturing you frantically scribbling in the dark, just like sweating over in a desk after blowing some massive trade. I mean, honestly, what were you even trading 2 years ago? That was such a complete disaster.
Well, we don't need to get into the specific ticker symbols, okay? Let's just say I had a very unhealthy obsession with trying to catch falling knives in like hyper volatile tech stocks, just buying the dip over and over until the dip became a crater.
So basically just setting your own money on fire.
Essentially, yes. But, I mean, this is exactly why, for episode 37, we are doing a deep dive into something that, frankly, hits a little too close to home for me.
Wow.
We're looking at the psychological traps in this industry. Because if you're listening, you're probably curious about the prop trading space. Maybe you're thinking about taking one of these evaluation challenges, but you're not funded yet.
Right. And if you're in that boat, you're probably spending, 6 hours a day staring at charts, trying to find some magic moving average crossover that just magically prints money.
Which totally doesn't exist.
It doesn't exist, but people still think it's a technical problem. Like they tell themselves, oh, if I just tweak my, Fibonacci retracements, which, by the way, if you don't know, is just drawing horizontal lines on a chart to guess where the price might bounce, they think if they just tweak that, they'll pass the firm's challenge.
Yeah, but what we're looking at today proves that technical skill is, frankly, the absolute least of your worries. The data is just, it's brutal. So we're looking at the 2026 data across the entire prop firm industry. And the initial challenge failure rates, they're sitting between 90 and 94%.
Which is just a massive graveyard. 9 out of 10 people handing over their evaluation fee just instantly hitting a brick wall.
Yeah, and out of everyone who tries, only 5 to 10% actually pass the evaluations to get a funded account.
Yeah.
So they beat the gauntlet, they get the simulated capital to trade with. But here is the kicker, and this is the stat that just completely blew my mind when I pulled it for this deep dive. Of that tiny group that actually gets a funded account, only a mere 7% ever receive a payout.
No, 7%.
7.
Single digit.
Out of the people who already passed.
So wait, they already proved they know how to trade, they beat the 90% failure rate, they played by the rules for weeks or months, and then they just blow it anyway before they can even withdraw a single dollar? Honestly, at that point, doesn't that just mean the whole game is rigged? If 90+% fail and then the quote-unquote winners still fail, the rules have to be explicitly designed for you to lose.
See, that's what the forums say. You go on Reddit and it's all, the firm is hunting my stop loss, or the market makers are rigged against me. But it's not the market rigging it, it's human behavior. You look at the breakdown of why these funded accounts fail, and 40% of prop traders are actively battling mental challenges.
Mental challenge, what does that actually mean in this context?
Well, the top two difficulties literally ruining these accounts are a lack of discipline, that's 37.8% of them, and emotional trading after losses, which is right behind it at 37.5%.
So they are literally just imploding from the inside out.
Completely self-destructing. Most of these blowups are entirely behavioral. They aren't getting outsmarted by Wall Street. They're just losing their minds in front of the screen, which is exactly where this whole concept of the revenge trading spiral comes in. This is the first big trap.
Oh, the dopamine chase. You lose a trade, and you just immediately want to punch the market in the face to get your money back.
Well, wait, no, it's not just wanting to get the money back. It's this impulsive, compulsive, borderline manic need where you completely abandon whatever trading plan you had and you just escalate. You increase the position size, you start taking way more trades.
You're just clicking buttons.
Yeah, but what's wild is the actual biology behind it. The sources we have go deep into the physiology of a market loss. Like when you take a sudden, unexpected loss, your cortisol levels can spike by around 300% in a matter of minutes.
300%, in your actual bloodstream.
Yeah. It's a massive stress hormone dump. And what that does physically, biologically inside your brain, is it literally diverts blood flow away from your prefrontal cortex.
Which is the part that does the math, right? The logic center.
The logic center, the consequence weighing center, all of it. The blood physically leaves that area and redirects to the amygdala, which is your fear and survival center.
The lizard brain.
Exactly. You are physically incapable of rational thought in that moment. You are in fight or flight mode over a blinking red number on a screen.
Which makes total sense when you watch someone revenge trade. I've seen it. They look like they're in a trance. They just start clicking the mouse faster and faster, completely ignoring everything they said they were going to do that morning. They are trying to fight a saber-toothed tiger, but the tiger is just a software interface.
Right. And this is exactly why the firms enforce daily loss limits. They are a guardrail. The prop firms put them there to stop this biological panic before you drain the entire account in one afternoon. The limit kicks in, locks you out, and saves you from your own amygdala.
Okay, I have to stop you there because I completely disagree with that framing. Calling them a guardrail makes it sound like the firms are doing you some huge favor. The daily loss limit is a tripwire. It's literally the thing that causes the biological panic in the first place.
No, they exist to protect the capital from the cortisol spike.
No, listen to me. If you are trading your own personal account and you go down 2%, you might be annoyed. You might be frustrated. But in a prop firm challenge, if you know the daily kill switch is at 5%, that 2% drawdown feels like you are staring down the barrel of a gun. The tripwire itself creates the anxiety. Traders breach these limits specifically because they are absolutely terrified of hitting them.
But you're ignoring the reality of the interface. If you remove the daily loss limit, that same trader who is already operating out of their amygdala is just going to burn through 20% of the account instead of 5%. The guardrail forces a hard stop. It physically breaks the trance you were just talking about.
It doesn't save the account if the anxiety of the guardrail is what made them take the stupid revenge trade to begin with. I mean, think about the sequence of events. You take a tiny, completely normal loss, a loss that should be part of a healthy strategy.
Right, which happens all the time.
Yeah. But because you know you only have a sliver of drawdown left for the day before you lose the whole challenge, you freak out. Your heart rate goes up, you up your leverage to get back to break even quickly before the firm notices, and bam, you hit the tripwire. The limit caused the escalation.
I completely reject that premise. You're basically blaming the speed limit sign for the driver choosing to slam on the gas and crash into the wall.
It's not a speed limit, it's a cliff.
The limit is just a static number. The trader's total lack of emotional control is what causes them to escalate. If you can't handle the mere existence of a daily boundary without having a cortisol meltdown, you frankly shouldn't be managing 6 figures of firm capital. It's a necessary guardrail, period.
We are just going to have to violently disagree on this. I think it's a psychological trap set by the rules themselves, disguised as a safety feature.
I mean, if you want to blame the rules instead of the trader, sure, but the data...
I'm blaming the psychological environment the rules create. But, okay, let's look at what happens when they aren't losing. What happens when the trader is actually winning and they don't hit your so-called guardrail? Because this is where the research gets even weirder.
You're talking about the consistency paradox? This is the second trap.
Yeah. The thing where they just randomly self-destruct right at the finish line?
Right. The sources refer to this as the fear of success. And it happens primarily when traders hit around the 80% mark of their profit target.
So they need, let's say, $10,000 in profit to pass the challenge, and they grind their way up to $8,000. They are so close, they can practically taste the funded account. And then they just act completely out of character. They just throw it all away.
They do, and the market hasn't changed. The volatility is the same. The only variable that shifted is their proximity to the goal. The data points to this being driven by imposter syndrome. It's an internal shift. Subconsciously, they feel like they don't deserve the success, so their brain creates a scenario when they blow the account.
Okay, honestly, I think fear of success is total psychobabble.
What? It's a heavily documented psychological phenomenon.
I don't care how documented it is, it doesn't make logical sense in this context. Nobody is sitting there, consciously or subconsciously, afraid of getting a payout. They want the money. They aren't afraid of succeeding, they're just choking under pressure, plain and simple.
But it's not.
It's like a professional golfer missing a 3-foot putt on the 18th hole to win a major tournament. They aren't afraid of winning the tournament, their hands are just shaking because the stakes are incredibly high and they want it too badly.
It is not the same thing as a physical mechanical error in golf. Trading is purely decision-based. You don't slip and accidentally buy 100 lots of gold. When you suddenly completely change your strategy at the 80% mark, you are subconsciously rejecting the outcome.
Rejecting the outcome? That's ridiculous.
The psychological term is homeostasis. Your brain wants to keep you in your familiar identity. If your familiar identity is struggling guy trying to pass a challenge, becoming a funded professional trader feels neurologically unsafe. Imposter syndrome makes them feel they don't belong in that new reality, so they invent reasons to take terrible trades to force themselves back to the familiar struggle.
That is wildly overcomplicating a very basic human reaction. Pressure makes people do dumb things. If you are two trades away from a life-changing payout, your brain just short circuits from the stress. You start seeing ghosts on the charts. You start forcing setups that aren't there because you were desperate to cross the finish line today. It's choking. It's over-eagerness. It's not some deep, unresolved childhood trauma about not deserving wealth.
I am not saying it's childhood trauma. I'm saying it's a documented subconscious self-sabotage. You are looking at the symptom, the choking, and ignoring the root cause. Why are they choking on a trade they've executed flawlessly 50 times before?
Because the stakes are higher.
The root cause is that their self-image hasn't caught up to their P&L, their profit and loss. They still see themselves as a failure, so when they are about to succeed, their brain corrects the dissonance by forcing them back to zero.
And I'm saying that's a really fancy academic way of excusing the fact that they just panicked under pressure and took a stupid trade. They choked because they wanted the money too fast, not because they were afraid of getting it.
Well, the behavioral data points to a deeper internal identity shift. Whatever, call it what you want, choking or self-sabotage. The result is exactly the same. They blow the account in the final stretch. But how do they actually execute that blow up? Like, mechanically, what do?
They start bending their own rules.
Right. Which leads us to trap number 3, this rule-breaking rationalization loop, the just this once mentality.
Oh, this is such a universal trap, not even just in trading. It's the, I've been so good, I can break my system just this one time because this specific setup looks so perfect.
Yeah, so you have a hard rule like never hold a trade over the weekend because the market can gap up or down while you're locked out. Or, never risk more than 1% of your account per trade. And then one day you look at the chart and your brain rationalizes it. Well, just this once, I'll risk 2% because this is a sure thing.
And the problem is it's never just once. It's not like a diet where you have a cheat meal and then you just go right back to eating chicken and broccoli.
No, the diet analogy doesn't even cover how destructive this is. It's more like you are building a house and your rule is to place a structural support beam every 10 feet. But one day you decide just this once, I'm going to skip a beam to save time.
And the house doesn't fall down immediately?
Exactly. That's the most dangerous part. You skip the beam, the house stays standing, and your brain learns a terrible lesson. It learns that the rules are optional. It learns you can get away with it. So you skip another beam and another.
Just slowly weakening the whole thing.
Yeah, and then a month later, a slight gust of wind hits the house, a normal volatile market event, and the entire roof caves in.
Because you structurally compromise the foundation over weeks of rationalization.
Yes. In trading, you bend that rule once, you happen to win the trade, and it cascades. Suddenly, you are over-leveraging constantly. You start holding trades overnight against the firm's policy. And the numbers back this up hard. Overtrading, which is usually the direct result of this exact rationalization loop, makes up 60 to 70% of all account breaches.
Wait, 60 to 70% just from clicking a button too many times?
Yep. Out of all the complex reasons you could fail, bad strategy, terrible market conditions, sudden news events, the vast majority of people fail simply because they couldn't stop themselves from taking trades that weren't in their plan. Because once you break your own rule and get away with it, your discipline erodes completely. And this is the fundamental thing people don't get about prop firms. They aren't just testing your ability to make profit. They are explicitly testing your discipline.
Which totally makes sense, because if you're rationalizing breaking rules on an evaluation with fake money, you're absolutely going to do it when they hand you a live, funded account.
Yeah, they don't want a cowboy managing their capital.
But, I mean, why is the urge to break the rules so strong in the first place? Like, what pushes someone who has a working, mathematically sound strategy to suddenly decide it isn't good enough? Why skip the structural beam?
Social media FOMO. The comparison trap. That's number 4 on our list.
Ugh, yes.
This is the worst.
You log on to Twitter or Instagram, and it is just an endless, curated feed of people posting screenshots of massive wins, blue numbers everywhere, payout certificates for $20,000, $30,000, $50,000, exotic cars. And nobody, literally nobody, is posting their red days, their blown accounts, or the fact that they are currently crying in their car.
So you're sitting there in your bedroom, grinding out like a very respectable, sustainable 1% a day, and you feel like an absolute total failure because some 19-year-old on Instagram just claimed he made 50 grand before breakfast while sitting on a beach. Right. It creates these completely unrealistic, warped benchmarks for what normal trading looks like. So what do traders do when they feel inadequate? They start overtrading. They abandon their safe, consistent strategy to go chase highly volatile assets like gold or NASDAQ just to keep up with the completely fabricated timeline.
They want the flashy screenshot.
Exactly. And there's actual empirical research on this now. The sources point to a 2026 FINRA study, FINRA being the regulatory body for brokers, and they prove that social media users are significantly more prone to extreme risk-taking in markets.
Because they're being conditioned to think extreme risk is normal. I mean, the irony of all of this is just painful. Think about it. Prop trading is arguably the most isolated solo endeavor on the planet.
Oh, completely. It's just you and a screen.
Right. There are no coworkers to compete with. There's no boss looking over your shoulder grading your performance. You have total autonomy. Yet people are voluntarily letting completely fake online flexes dictate their personal risk management.
It makes no sense.
It doesn't. You're letting someone who probably Photoshop their MT4 screenshot. And MT4 is just the trading platform software, but people literally buy fake plugins to make it show fake millions. You're letting that guy ruin your real account.
It's toxic. It completely hijacks your baseline for reality. And it leads to this deep sense of desperation. You feel like you're falling behind in a race that doesn't even exist.
Yeah.
Which brings us to the final psychological trap, number 5. And this is the one that really gets people stuck in the mud for years. The sunk cost fallacy.
Oh, this is the dark side of the industry. This is where it gets genuinely depressing.
It really is. So the sunk cost fallacy is that feeling of, I've already spent this much money on evaluation fees, I absolutely must pass. Because remember, for you listening who maybe don't know the exact mechanics, taking these challenges costs upfront capital. You pay a few $100s to take the test. And the data shows traders spend an average of $4,270 on multiple challenge attempts over their journey.
$4,270 on evaluation fees, just for the chance to try and get a funded account.
Yeah. And when you are $4,000 deep into a cycle of failing and buying again, the psychological pressure is unbearable. You aren't trading the market anymore. You are trading your desperation to get that $4,000 back. You need to validate the money you've already burned. And that desperation fuels all the rule violations, the overtrading, the revenge trading we just spent 20 minutes talking about.
Okay, I'm just going to say it. This is where the prop firm industry crosses the line from being an opportunity into being openly, wildly predatory.
Wait.
They know this fallacy exists. Their entire business model explicitly exploits the sunk cost fallacy. They are actively farming repeated fees from struggling traders who are addicted to the idea of getting funded. It's no different than a casino keeping the ATM right next to the blackjack table. They want you to blow up so you swipe your card again.
Whoa. Okay, I have to push back on that heavily. As someone who works in this space, you are looking at this completely wrong.
How? They are literally profiting off of people failing and trying again. The 90% failure rate is their revenue stream.
Because it is an asymmetric opportunity. Yes, people spend an average of $4,000 trying to pass, which hurts. But compare that to trading your own capital in a retail broker. If you blow up a $50,000 personal account, you lose $50,000 actual dollars. Your life savings is gone. If you blow up a $50,000 prop challenge, you lose, what, a few $100? There is zero personal capital risk beyond the evaluation fee.
But they gamify the rules to make sure you keep paying that fee. The tight drawdowns, the trailing limits, they are explicitly designed to trip you up, to make you fail right at the finish line, so you have to buy another challenge to chase the sunk cost. It's a treadmill that powers their business.
That is just not true across the board.
Yeah.
Yes, there is a dark side to the industry. There are bad actors who use sneaky rules, but that's exactly why platforms exist, to aggregate and compare firms. That's literally the entire point of what we do at JoinProp. We compare the rules so you can find a firm that doesn't use those predatory trailing drawdowns. It's only a trap if you blindly hand your money to a firm without understanding their specific rule structure.
Okay, but you can't deny that the industry at large thrives on the churn. If 90 to 94% fail, the industry is fundamentally funded by failure. You are defending a system that relies on people not being able to overcome the sunk cost fallacy.
I am defending the opportunity. If a trader cannot control their own psychology, if they cannot stop themselves from rage buying their 10th challenge in a row at 2 a.m., that is a lack of personal discipline. The prop firm isn't holding a gun to their head, forcing them to hit buy again. The opportunity to manage massive amounts of capital for a tiny fee is real. You just have to treat it like a professional instead of treating it like a lottery ticket.
Fine, Ken. If you think this system is so great and fair, how does someone actually survive it without going broke? You just spent all this time outlining how incredibly difficult this is, how your brain is biologically working against you with cortisol, how the rules trip you up, how social media ruins your expectations. If it's such a great opportunity, what is the actual fix?
The fix is building what the sources call the four-layer psychological defense system. It's basically a rigid framework designed to protect you from yourself. You have to externalize your discipline so you aren't relying on willpower in the heat of the moment.
Okay, let's unpack that. I want to know how you actually stop the amygdala hijack. What is layer one?
Layer one is pre-trade. It's all about rituals and checklists. So before you even look at a chart, before you even open your laptop, you go through a physical, written checklist.
Like a literal piece of paper.
Yes. You ask yourself, is this specific setup in my trading plan? Am I feeling rushed today? Did I sleep enough? Am I taking this trade just because I'm bored and want action? It forces your brain out of that emotional reactive state and forces it back into the rational logical state by making you articulate your reasoning.
I like that. It's like putting a speed bump in front of your own impulses. You have to verbally justify the trade to yourself before you risk the capital.
Exactly. You are verifying that the prefrontal cortex is actually online, but that's just the start. What happens when you're actually in the trade, the market turns against you, and that cortisol spike hits?
Right, because checklists don't help when you're already sweating.
That's layer two, intra-trade emotional monitoring. This is where you have to get really, really good at recognizing your own physical stress signals in real time, because your body reacts before your brain registers the panic. Like, is your jaw clenching? Are you gripping the mouse really hard? Is your breathing getting shallow?
You know, I actually do that when I'm working on a tight deadline. When I get stressed, my shoulders end up basically touching my ears. They just creep up my neck. I don't even realize it until I'm so tense I get a headache.
Yes. Everyone has a physical tell. And the rule for layer two is the second you notice that physical stress signal, the moment you realize your shoulders are up or you're death gripping the mouse, you step away.
Just leave the desk.
You step away. You don't close the trade immediately. You don't adjust the stop loss. You just physically stand up, push your chair back, and walk away from the screens until the physical symptom stops.
Which physically breaks the trance. It stops the revenge trading spiral we talked about earlier because you are no longer staring at the blinking lights, triggering the fear.
Right. You have to remove the stimulus to lower the cortisol. Okay. Layer three.
Let me guess. Post-trade?
Post-trade journaling. But this isn't just writing down your entry and exit prices like a tax document. You have to journal your emotional states. Did you feel massive FOMO before you clicked buy? Were you sweating during the drawdown? Did you feel overly arrogant after a win? And you track the emotions to spot your own behavioral triggers.
So you can start to see the patterns in your own self-destruction. Like, oh, I'm looking at my journal, and every time I take a trade after 11 a.m., I'm bored, I force bad setups, and I lose.
Yeah, exactly. You find the structural flaws in your own psychology. But layer four is the most important one. This is the ultimate safeguard. If layers 1 through 3 fail, layer 4 saves your account. Account circuit breakers.
Wait, don't the prop firms already have those? The daily loss limits we spend 10 minutes arguing about?
Yes, but the whole point of layer 4 is setting personal limits that are significantly stricter than the firm's rules. You enforce them yourself, or you use software to lock yourself out. If the firm allows a 5% daily loss limit, your personal circuit breaker is 2%. The second you hit 2%, you shut down the platform for the day. You walk away.
Oh, that's incredibly smart. That actually completely solves our argument from earlier. If you use a personal 2% limit, you never actually get anywhere near the firm's 5% tripwire. So you never feel that existential panic, that staring down the barrel of a gun anxiety of losing the whole account. You maintain the buffer.
Exactly. You maintain total control. You are dictating the terms of engagement, not the firm. The firm's rule becomes irrelevant because your personal rule is so much tighter. But honestly, even with this entire four-layer system, a massive part of surviving this gauntlet is choosing the right battlefield to begin with. You have to compare firms and understand how their specific, unique rules dictate the psychological pressure you're going to face.
Right, because not all firms are identical. People treat them like they are all the same, but the landscape is totally fractured. The rules are wildly different from company to company.
Completely different. You have the high-pressure firms. Take FTMO, for example. They are the biggest name, but they have a very strict 5% daily reset, which is calculated based on your balance or your equity, whichever's higher, and a 10% maximum overall drawdown.
Yeah.
It is a very tight box, very high pressure.
And if you break it, you're out.
You're out. Or look at the fivers. They have incredibly strict consistency rules where no single day can make up a massive percentage of your total profit, which can really heavily trigger that fear of success we talked about. And Top Step, they use a 3 to 4% trailing drawdown, which literally moves the finish line on you while you trade. If you make money, your loss limit trails up behind you.
Yeah.
Extremely high pressure.
So if you know that you are someone who struggles with anxiety, or if you know you get those massive cortisol spikes when a limit is approaching, choosing one of those trailing drawdown firms is just financially suicidal.
Yeah.
You are just setting yourself up to fail.
Right. You are voluntarily putting yourself in the worst possible psychological environment for your specific personality. But then you have firms with moderate or much lower pressure. Funded Next. They have a 5% daily and 10% overall, but their trailing drawdown is a bit more forgiving. But then look at a firm like My Funded Futures. They have absolutely no daily kill switch, no daily loss limit at all. None.
Yeah.
And their trailing drawdown is calculated end of day, not intratrade while the market is moving.
Oh, wow. So with My Funded Futures, you could theoretically go down like 8% in a single day as long as you don't hit the maximum overall drawdown. And you wouldn't lose the account. You wouldn't hit a tripwire.
Yeah. The psychological relief of not having a daily timer ticking down on your equity is massive for a lot of traders.
Yeah.
It completely changes how you interact with the market.
So if you know you have a cortisol issue with daily limits, you should obviously choose a firm like My Funded Futures. Like, it's not even a question. You have to match your own psychological weakness to the firm's rule structure. You use the firm's rules to patch your own behavioral holes.
That is the whole point.
Uh-huh.
This is why comparing firms matters so much. You aren't just looking for the cheapest evaluation fee. You are looking for the rule set that minimizes your specific behavioral traps.
It's like finding a suit that actually fits instead of just buying the first one off the rack, throwing it on, and then wondering why you can't move your arms.
That is a perfect way to put it.
Yeah.
So if we synthesize all of this, all the stats, the failure rates, the biology, the core thesis here is really profound. Psychology is your edge. It is not your enemy. It is the only edge that actually matters.
Right. The industry wants you to think it's all about technicals. They want you buying indicators and courses. But mastering your own brain, controlling that amygdala response, means you will actively outperform traders who have vastly superior technical setups, but zero emotional control.
Because these prop challenges, at the end of the day, whether you think they are predatory or not, they are essentially a hidden psychological filter. They are designed to weed out the impulsive, the greedy, and the undisciplined. And, I want to leave you with a final thought to really mull over today, something that builds on everything we just broke down.
Oh, here we go. Lay it on us.
No, seriously, think about this deeply. If 90% of traders fail because they literally cannot handle their own psychology, if they're blowing up because of fear and revenge trading and social media jealousy, is the real edge in the market simply knowing yourself better than the person on the other side of the screen? Like, we spend years studying candlesticks. We memorize chart patterns. But if you spend that time studying your own triggers, your own fear, your own ego, maybe that is the actual holy grail of trading. You aren't trading the market. You are just trading yourself.
I mean, when you put it like that, it makes you realize why so few people actually get that payout. Looking in the mirror and admitting you have no discipline is a lot harder than looking at a chart and blaming the algorithm.
It really is. It's the hardest pill to swallow.
Yeah.
Well, that is going to wrap it up for our deep dive today. It was a messy one. Definitely got a bit heated, but an important one.
Always is. And hey, next time we do a deep dive, we're looking into something completely different, so you won't want to miss that.
Definitely. Until then, stay disciplined, watch those personal circuit breakers, and we'll see you next time.
Bye, everyone.